All right, so this is David Shaw coming to you today in our somewhat brand new format. Clark and I have decided that we're going to continue to bring you our joint recording every week where we tackle a subject we think that we can add value and educate you and give you some useful advice as you plan your own financial future. With that being said, we both bring individual qualities to our podcast, and so we wanted to bring you more episodes. We wanted to bring you more content in general, but it's just very difficult scheduling each other and whatnot and bringing on guests and whatnot. So we're going to continue to do that. But we're going to have a crack at bringing you individual episodes where we deal with topics or particular ideas that we might want to flesh out just individually without in that conversational format, kind of more in that just quick hit, like, did you know this? Have you thought about that? I've experienced this kind of way. So without further ado, I'm looking today. We just had an absolute blowout jobs report. So today's date is Friday, January 10th, right? Stock market is taking an absolute conniption. The Dow's down 700 points on the day. We have the Nasdaq down 1.63%. The S&P down 1.54%. And this is on the back of a bunch of losses last week as well. So we could see a possible bear market, in my view, on the stock market shaking itself out over there. So it's important to understand why the market is behaving the way it is. Now, it is simply down to the price of bonds, right? As this hot jobs report comes out today, so to give you some facts, right? The US payrolls grew by 256,000 in January. So logic would tell you more jobs, a better economy. Surely the stock market should go up in that environment. But unfortunately, that is not the logic of Wall Street. Wall Street wants access to cheap debt. That's how it funds itself. That's how it rolls over, older debt. That's how it funds new projects. It funds things on cheap debt. And so when debt becomes expensive, Wall Street doesn't like that companies are going to find it harder to raise and access capital at a higher rate. And so when you see these hot jobs reports coming in, and I made a big mistake with this over my life, thinking, oh, the economy's doing well, stock market must be reacting positively to that. And it's taken me quite a long time to really absorb that quite messed up correlation between lower interest rates and what creates lower interest rates in the first place, which is distress, which is fear, which is recessions. That's actually what creates low rates. It's not buoyancy and everybody doing well. And so I wanted to tackle, the kind of elephant in the room at the moment as far as Treasury yields, because that's what's causing all of the stress, right? What we have here is, and it's quite systemic, is the US government has created a huge deficit for itself, and it needs to roll over its bonds all of the time with expiring bonds and releasing new bonds. And when the US government releases new bonds, people, investors, sovereign wealth funds, etc., they want a higher yield on those new bonds, and they want to pay lower prices on those new bonds because they don't like the amount of debt that's out there, and they do not like the near term future and even indeed the long term future of the US debt position. Now, you might think, okay, this is all very mercurial, but how does it impact you? It impacts you in that if you want to add a new investment home to your life this year or next year, or you have some debt that's rolling over, the US government creates this higher interest rate environment. It's amazing for me to see my relatives and friends at home in Ireland. They on a a floating interest rate loan, they can borrow at 1.5% and 2%. Now, if they want to fix, that's a completely different price because they don't have a 30-year fixed product over there. But they can take a variable rate loan that maybe 2.25%. It's completely unheard of over here. And so when we have a situation where treasury yields are rising, we have a situation where the prices of those bonds are falling. And that sets us up for quite a damaging near term environment and quite frankly, a little bit of a dangerous banking environment because a lot of the banks have a lot of their liquidity based in old release bonds. So if the new bonds are priced lower with a higher yield, what does that do to the older bonds that are priced higher and a lower yield? Nobody wants to buy them. And essentially, those bonds have just endured quite a heavy and precipitous loss. Now, there's a lot of banking institutions and sovereign wealth funds that are holding these, older bonds with lower yields and higher prices, and they're not going to be able to get rid of them. And so that could set us up for a somewhat rocky future in terms of banking stability and whatnot. And so this current trend of rising treasury yields and how these treasury yields are impacting interest rates. So the more the US government goes out and borrows, the more you pay for your mortgage. It seems unfair. It might be, it might not be, but it's this behavior on the capital markets that impacts our ability to get new loans, but it also impacts everybody else's ability to get a decent rate of interest. And so right now, we have an entire housing market that is at pretty precipitous prices, and we have pretty high interest rates. And so logic would determine that a high interest rate environment that seems to be getting higher, not lower. Now, that higher interest rate environment is generally down to we have a very robust economy and we have a government that's borrowing a lot of money. So, in my view, there is a certain amount of downside risk to pricing of real estate. That's just the downside risk. That's what logic would tell you. But that's what logic would have told you when rates start rising in 2022, in 2023, and 2024, and so on. But what has been holding real estate prices up? We all know what those things are. One, the lock-in effect. We all know what the lock-in effect is. People with lower interest rates on their loans are not going to trade or sell their home for a much higher interest rate and, quite frankly, a much higher priced home with higher property taxes. Who would do that? Nobody does it. And so, by and large, there's very little inventory coming to the market. Now, I'm going to go through the inventory statistics for the Tampa Bay area here in a moment. But what we want to do is we want to look at what the future holds for rates in general. And now this higher jobs report and potential inflationary impact of Federal Reserve policy and the in the M2 money supply and providing more and more money and printing more money, that's creating inflation. Tariffs may or may not increase that inflation. You're taking labor out of the labor force, particularly in the Sun Belt where a lot of houses get built. Taking a lot of labor out with the immigration policies we're likely to see in 2025 may also be inflationary. And so I don't see any real downturn in bond yields in the near future. And so I think we're looking at a higher rate environment. Now, I am not an economist, and there's much more to these things than some backseat observer here like myself. But I just have to look at what I see, and I have to I have to make my own decisions, and I have to make my own approach to 2025 and what it is I'm going to do in 2025 based on this information. And so I'm a little bit worried how banks and wealth funds, particularly sovereign wealth funds, are going to hold their lower rate bonds. They can't sell them. They're going to have to bring those lower rate bonds to maturity. And so there's a certain exposure risk. As interest rates rise, existing bonds at lower rates are going to lose value, resulting in potential losses for these institutions. I'm a little bit worried about that downside. I've mentioned that a moment ago, but there's some broader financial implications, right? Borrowing costs. Unfortunately, I don't see borrowing costs coming down. I don't see any, even green shoots of interest rates coming down kind of anytime soon. I just see more inflationary pressures and higher rates on the horizon than I do, disinflationary activity out there. I just don't see it. And so what are the ripple effects, across the entire economy? Well, we've had an incredibly strong economy, incredibly strong jobs environment. But if you go back to a lot of other previous recessions, and I'm not forecasting recession, I'm not that kind of person, but it's always the growth on the employment side is always highest just before there's some kind of sudden shock, right? It's always highest just before some sudden shock. And I lived through the 2008 and the shocks there with Bear Stearns. That was the first domino to fall of the banking crisis, and we all know what happened, thereafter. And so the environment right now, I can't say I love it. I can't say these rising treasury yields, these rising and therefore rising interest rates are making me feel particularly great about where and how to strategize placing my own capital this year. But we've had many, many conversations before. I'm going to continue to dollar cost average into my market. And so let's have a quick look at my market. I've just had the December 2024 information just a few moments ago come out. This is the real estate active and pending data. And so I'll just run the numbers. We have 24% more active listings now in December 2024 than we did in 2023. So listings are up. Are more people selling, right? But we have new listings, which is active listings and new listings are somewhat different. Active listings are things that are on the market in general, and new are just brand new. We actually see a 17% decline in new listings. And so fewer and fewer people in December 2024 are starting to list their homes. Think about that. This might create a little less inventory on the market if this continues. We have 1% more sales pending in December 24 than we did in December 23. So the market seems to be holding up somewhat, right? Listings sold. We have 21% more listings sold in December 24 than we did in November 24. So sales month on month are increasing. So things are still selling in the marketplace. We have 9% more sales in December 24 than we did in 23. So anybody telling you that nothing's selling and the market is crashing is lying to you, or they don't have the data. But what is happening is how long it's taking houses to sell. It now takes 66 days for a house to sell in the Tampa Bay area. Believe me, as a house flipper, that is an excruciatingly long time to find a buyer. And so 66 days, that would worry any house flipper. And certainly they're going to have to augment their underwriting and allow for this extra on-market time. There's certain things that a house flipper can do to reduce that, is make sure that they price their property correctly and make sure they present a property that's just absolutely beautiful and leaves nothing to the imagination. It's just absolutely delivered beautifully, beautiful exterior. Everything about it is what a buyer would emotionally want to buy. So total sales volume came in Tampa Bay at for the month at 6.49 billion. Don't have people tell you that hurricanes and storms, everybody's running away. We have had 24% more sales volume month on month than we did in November. And there are 8% more sales volumes than there was this time last year. Again, that does not tell me that there's a market crash in the Tampa Bay area. And I use the Tampa Bay area as really a gauge for most of the Southeast. So most of Texas, most of Florida will kind of, within reason, most urban MSAs will probably have similar kind of numbers to these numbers here. Now, interesting prices. So prices are up 2% from a month ago. 2%. Prices have risen 2% on average in the last month, but they are down 1% on a year ago. So anybody out there on YouTube telling you that taking one house and showing you a discount and making you think the whole market logically is disappearing into the ground, again, is lying to you. But house prices have gone down 1% since December 23. Okay. So whilst there's more sales, whilst there is more pending sales, there's also more active listings. There's also more new listings. And so prices have come down because there's more supply in the market by just 1%. Now, a big one for anybody following months of inventory, and I follow it pretty religiously. So months of inventory in the Tampa Bay market is 4.9 months. Now, 6 months is considered a balanced market. Anything less than 6 months is considered a supply restrained market. Anything more than 6 months is an overly supplied market. And so we have 4.9 months supply of overall, and this includes condos, houses, multifamilies. If I strip out condos and I strip out multifamilies, and I'm just talking about single family homes in the Tampa Bay area, I will assume that we have somewhere less than 3.5%, if not 3% months of inventory. So single family homes in the Tampa Bay area remain very, very robust and in short supply. And so we have 17% less inventory in December 2024 than we had in November 2024. So inventory's gone down. But on the year, there is 14% more inventory if I stretch that out over a year. We've had a pretty high interest rate environment for 3 years, 4 years. I am looking at the current interest rate environment. I'm looking at the 10-year note right now. And when I look at the 10-year note as it stands right this minute, the 10-year is standing at 4.763. Add 2.5% onto that for the spread to find out what an investor loan's looking like. So an investor loan right now is still going to come in at 5, 6, 7.5. Yeah, about 7.25% you want to allow for an investor note, so an investor loan. So it's not great, but it's equally not a killer blow. That's my 10 cents. If you think in 2025 that the market is crashing, I think you're wrong. Logic would tell me that these higher interest rates are going to cause more pain on the housing market. And for sure, it makes buying a house more expensive for your average person. But I think after 3 years of high interest rates, the people who want to buy houses are buying houses. The people who are waiting are going to continue to wait. But the people who want to buy a house, they're buying a house. And that's it. And they're buying the best house they can. If you're selling a house, price it right, and you won't have to do any price deductions. Don't come into this market thinking you're going to get the highest price in the neighborhood unless you've got some really, really special piece of real estate. And so like I said, I think on a previous episode, 2025, I think it's going to be more of the same. We're going to have a lot of this negative connotation, high jobs, great economy. Sounds great. Be happy about that. High debt, high treasury yields. Call your local senator and tell them to reduce the government spending. I think that's the way to go on that one. But overall, in terms of your own economy and your own approach, interest rates, are going to stay fairly elevated, I think, in for the remainder of 2025. I don't see any big move either way. And so plan accordingly. And just remember, you've only a certain amount of time to invest in your life. Don't stand on the sidelines. I hope this was useful. That's me out for today. Thank you. Bye.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.